Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the boring stuff so you don't have to. You know that feeling when you get a super long and detailed report in the mail and you just want to toss it? Well, today we are diving headfirst into one of those, a 10Q report from CubeSmart or CubeSmart. Get ready because we are about to decode exactly what these numbers mean for their self-storage empire. And hey, if you love getting crunchable financial insights without all the corporate jargon, make sure you are subscribed and check out our Discord community linked in the description below. Alright, so this document is a quarterly report filed every 3 months with the US Securities and Exchange Commission. It gives us a snapshot of how the company is doing financially. CubeSmart is a big name in self-storage, owning and operating properties across the US. They also manage a lot of properties for other people. Now, this report is a bit special because it combines two entities, CubeSmart, the parent company, and CubeSmart LP, the operating partnership. Think of it as a company and its main operating arm presenting their financials together. Let's jump right into the numbers. Looking at the consolidated balance sheets, we see the company's assets, liabilities, and equity as of the 30th of September 2025 and the 31st of December 2024. On the asset side, storage properties are by far the biggest chunk. As of the 30th of September 2025, they are valued at over $8 billion. That is a massive amount of real estate. And what is really interesting is that these storage properties are growing. Between December 2024 and September 2025, the gross storage properties increased by nearly $500 million. That tells us they are actively buying and building more storage facilities. Now for the liabilities, the elephant in the room here is unsecured senior notes. As of the 30th of September 2025, these notes total over $3.2 billion. That is a substantial amount of debt, and it has increased significantly since December 2024 when it was about $2.78 billion. This indicates they have been borrowing heavily, likely to fund those property acquisitions and developments we saw earlier. This debt definitely needs attention. Moving over to the income statements, looking at total revenues, we see positive growth. For the 3 months ended the 30th of September 2025, total revenues were $285 million, that is up from about $270 million in the same period in 2024. That is a healthy approximately 5% increase. And for the 9 months ended the 30th of September 2025, revenues reached over $840 million, up from about $798 million in 2024. This means their core business of renting out storage space and providing management services is bringing in more money. But here is where we need to dig a little deeper. While revenues are up, operating expenses are also climbing. Property operating expenses jumped from about $81 million in the third quarter of 2024 to over $90 million in the third quarter of 2025. That is an 11% increase, and depreciation and amortization jumped by a huge 30%. This means the cost of running those properties, the expenses like property taxes, utilities, repairs, and maintenance are going up significantly. It is good that they are expanding, but they need to make sure those new properties are profitable enough to cover these rising costs. Here is a big one. Interest expense on loans. For the 3 months ended the 30th of September 2025, it hit almost $29.4 million, up from about $22.8 million in the same period in 2024. That is a 29% increase. And over the 9-month period, it increased by 23%. This jump in interest payments is happening for two main reasons. First, their total debt has gone up, as we saw with those senior notes. Second, and this is important, interest rates in general have likely increased, meaning they are paying more for the money they borrow. This rise in interest expense is putting a dent in their bottom line. So with revenues going up but expenses and interest costs also climbing, what is the final result? Net income attributable to the company's common shareholders for the third quarter of 2025 was about $82.9 million. That is down from nearly $100.8 million in the third quarter of 2024. And for the 9-month period, net income attributable to common shareholders dropped from about $289 million in 2024 to just over $255 million in 2025. This means despite growing revenues, the increased expenses and interest payments are costing them profit. Their net income is actually shrinking. Now let's talk about strategy. CubeSmart is clearly on an acquisition spree. On the 20th of February 2025, they acquired the remaining 80% ownership in what they call HVPIV assets. This was a massive deal costing over $452 million. This move consolidated 28 storage properties into their wholly owned portfolio. This acquisition immediately boosted their property assets. They also made other significant acquisitions in 2024, totaling around $200 million. This aggressive expansion is a key part of their strategy to grow. Looking at non-controlling interests, we see they are heavily involved in joint ventures. These are partnerships with other companies to build and operate storage facilities. As of the 30th of September 2025, they have about 22 consolidated joint ventures with over $386 million in assets. These joint ventures are a crucial part of their growth strategy, allowing them to expand without putting all the capital at risk themselves. However, note that the majority of these joint ventures are not variable interest entities, meaning CubeSmart is not the primary beneficiary consolidating them. They are accounted for under the equity method, but it is important to see the scale of these partnerships. Let's check the efficiency of their operations. For their same-store portfolio, their realized annual rent per occupied square foot was $22.99 in the third quarter of 2025. This is almost identical to the $23 in the same period of 2024. This indicates that their pricing power on existing stores is stable, which is good. However, the change in this metric shows very little improvement, which suggests they are not significantly increasing rents on their established properties. Now let's touch upon the risks they face. The company is very exposed to interest rate changes. They have a lot of debt, and if interest rates go up, their interest payments will go up too. They did a calculation saying if interest rates increase by just 1%, that is 100 basis points, the fair value of their fixed rate debt would drop by over $125 million. That shows how sensitive their balance sheet is to market interest rates. It is a substantial risk they are managing. There are also risks related to competition, the failure to execute their business plan, and even cybersecurity threats. Now let's put on our Warren Buffett hat and take a look at the bigger picture for CubeSmart. They are clearly a growing company aggressively acquiring and developing properties. Their core business of self-storage seems to be holding up well with stable rental income per square foot. However, the company is carrying a lot of debt and interest expenses are eating into their profits. This is a classic REIT dilemma. They need to borrow money to expand, but rising interest rates make that expansion more costly and reduce profitability. The fact that their net income has declined despite revenue growth is a red flag. While their expansion is impressive, it comes with significant financial risk, especially in a high interest rate environment. The company direction seems focused on growth through acquisition and development, which is a sound strategy for real estate companies, but they need to manage their debt carefully. The opportunities lie in continuing to acquire and develop well-positioned properties and potentially finding ways to reduce their reliance on debt or refinance at more favorable rates. The risks are clear, namely rising interest rates, intense competition, and potential economic slowdowns impacting tenant ability to pay. In conclusion, CubeSmart is a major player in the self-storage industry with a clear growth strategy. However, investors should keep a close eye on their debt levels and interest expense. The company is expanding, but the profitability of this expansion is being challenged by rising borrowing costs. It is a delicate balance they are trying to strike. Alright, that is our deep dive into CubeSmart's latest financial report. What are your thoughts? Are they building a solid future or heading for trouble? Let me know in the comments below. If you found this video helpful, please give it a thumbs up and subscribe for more of these decoding sessions. And remember, our Discord community is always open for more in-depth discussions. Join us there. Linked in the description. Thanks for watching, and well, see you in the next one.